Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Kirk Spano, welcome back to the show.
How are you doing?
Doing well. So let's talk about energy. And you've got a thesis regarding Saudi Arabia and Canada that ends up with oil prices going up, which will be really exciting to all of our friends invested in oil equities, because this is December 2018, and it's been a painful couple months.
Yeah, let's talk about the oily story here. So back in 2017 in June, the Saudi Arabians cut their export of oil to the United States. And that's important because we need Canadian heavy sour and Saudi Arabian medium crude to create gasoline and diesel and other distillates, because it gets blended with the light sweet crude that we produce. Ultimately, when they pull back on what they're sending to us, it causes the refineries to have to spend more money to create the gasoline and the diesel, and inventories come down. So this year, when President Trump agreed to do the Iran sanctions, and I say agreed because Trump wanted to do it, but the Saudi Arabians have been pushing for the sanctions on Iran for a while. The Saudi Arabians immediately increased their oil output by 1 million barrels a day, and it took them 1 month to do it. So they had the spare capacity, and they used it, and that was the quid pro quo between the Trump administration and the Saudis.
Okay.
So for 5 months, the Saudis increased their oil exports to the United States substantially by about 800,000 barrels a day. You can go to the EIA website and see how oil exports to the United States from Saudi Arabia went from about 600,000 barrels a day up to about 1.3 million barrels a day. So that'd be 700,000 more barrels. Fast forward, oil prices start crashing in October. And we've already talked about how the Fed pulling money out of the system is hurting the markets, but the oil equation was all goofed up because the Trump administration gave all those waivers, right? Gave 8 waivers to China and India and several other nations to keep getting Iranian oil. So rather than having 1.5 or 2 million barrels of Iranian oil come off the market, only about 900,000 or 1 million barrels did. So all of a sudden, there's this almost 1 million barrel overhang in the market overnight. And the traders seized on that. And they pounded the heck out of oil prices for about 9 weeks. And it just started leveling off after the OPEC meeting, right? So now we're in that, we've been in that sideways motion with a little bit of upturn. And what is the response from the Saudi Arabians? They have announced that they are unilaterally going to pull 1 million barrels of production off. And they are going to unilaterally send the United States at least 500,000 barrels less of oil per day. On top of that, and I'm calling this Justin Trudeau's revenge, Canada is cutting their heavy sour to us by 325,000 barrels a day. So that means that over 825,000 barrels a day that we were getting in November, by January we won't be getting. That is a 25 million barrel a month reduction in the crude oil inventories in the United States, because right now U.S. production has plateaued because of the shortage of pipes in the Permian that won't be solved until the second half of next year. So between now and about July of next year, the Canadians and Saudi Arabians can force the inventory for the United States down by 25 million barrels a month. What is that in context? Oil inventories in the U.S. got up to about 450 million barrels last month, which is the highest it's been I believe in 6 or 7 years. It's higher than the 5-year average again. What's interesting about that is that in developed economies, that represents over half of all the global oil inventory. So when people talk about global
half
oil,
the global oil inventory is in the U.S.
it's actually a little bit more than that. It's hard to figure out the numbers globally, but it's over half. It might be 2/3. So somewhere in that range, the United States basically has half or more of all global oil inventories for developed markets, for OECD. And when people talk about the global oil inventory glut, they're either misinformed or they're lying. If you're a trader, you're probably lying. And if you're in the media, you're probably misinformed. So it really depends on where you are. But with the Saudi Arabians and the Canadians cutting exports to the United States, that's going to drive the price of WTI up here. And that's going to happen until we get to more of a plateau in that $70, $80 range. Sometime late next year would be my guess, middle to late next year, somewhere in there. At that point, the light sweet crude is going to come on, another probably 1 million barrels a day we're going to produce in the United States. We're going to have to swap
and the light
that
sweet
oil.
Crude, that's what the U.S. produces.
That's what's here. That's what we have in shale. We'll swap some. We'll sell some of that oil, and then we're going to probably start getting more oil from Mexico, and ultimately Canada will start selling us more of their oil. So there's a long-term equation here where the land-based shale production and the Saudi Arabian spare capacity, which are really the two places in the world with spare capacity right now, are going to be able to keep up with growing oil demand globally for about the next 3, 4, 5 years. After that, it's hard to tell because we don't know what oil demand will be by the middle of the 2020s. Probably gets up to 110 million barrels a day, give or take. But at some point, electric vehicles are going to get here because they just had a major battery technology improvement. And we'll see how that goes, how long it takes for that to be manufactured at a price that people will buy. My guess is about 10 years out. I've put the chart out there. Oil demand probably goes up for another decade or so, and then it starts to flatten out, peak oil plateau, and then it falls off sometime in the 2030s. But between late next year and for several years thereafter, there's going to be a balance in the oil market where the producers and then the people who need the oil, roughly supply and demand will be in balance because the Saudi Arabians have that much power in an increasing oil demand environment. Someday that changes, probably not until late next decade though. So we are going to have roughly a decade where the price of oil is in that $70, $80 range. Now, there can be spikes, right? Because you can have oil disruptions, you can have wars, you can have whatever else is can happen out there. You can have economies collapse like Venezuela, so they can't even afford to drill. But now Russia's promising them money too. So we're probably going to have enough oil for the better part of a decade, and then we're going to go back in the surplus. So in the long term, we're going to have to get rid of our oil investments. But in the short and intermediate term, you probably have two pretty good opportunities. The first one is until oil gets to somewhere in the 70s, you can actually ride the price of oil up. And then USO, right? The U.S. Oil Fund is a good place to do that. I recommend using options if you're going to really try to take time to figure it out. Do not use leveraged ETFs unless you are a day trader because all those securities reset daily and the negative algebra when something goes down really works against you. But what is giving the heavy sour and the medium crude so much power? It's because our refinery system doesn't allow us to just use light sweet crude, right? If we could only use light sweet crude, you would think that we would ramp up production all the way up to 17 million barrels a day at some point. And we might, I doubt it. I don't think we have that kind of capacity, but we use over 17 million barrels a day. I think it's 18 million barrels a day now. And we only produce, 11.3 million barrels a day. So there's still a deficit. We get oil from Canada, Saudi Arabia, Mexico, some other places to make up, the difference. Our refining system is set up to use that type of oil. So even if we get to the point where we are exporting more than we import on a regular basis, we just did it for 1 month, you still don't have a refining system that can take just light sweet crude.
Mm-hmm.
So you take a look, and what does that mean for the oil companies? That means that certain oil companies, the ones that have the best balance sheets and the best rock meaning cheap oil, lots of it. Those are the companies that are going to do really good. Companies with a lot of debt, companies that are using some of the more expensive shale oil, they're going to have problems. But there's certain companies out there in the Permian Basin in particular, and then a couple other spots that should do very well once these pipelines come online in Texas.
Like what are some of the ones you like? Can you share?
Some of those I'm public with. Some of those I'm not.
Sure.
Members get the whole dirty dozen. So we have a dirty dozen oil stocks that we like. I think dirty dozen is kind of clever. Just so happened that there was 12.
Yeah, it might make a good movie too.
Yeah, right. It might make a good movie. What do you think that movie would have to be about?
The new one?
Sure. What would the new Dirty Dozen be? Didn't they?
The new Dirty Dozen.
Did a new Dirty Dozen.
Huh? I'm thinking about Jim Brown, man. I don't know what you're thinking about.
Yeah, Jim Brown. There you go. Anyway, so you've got companies that I've talked about in the past.
Mm-hmm. Encana.
Encana. Okay, so we'll start with Encana since you brought it up. Encana just bought new feed, and the analysts hate it and cut the stock in half. I'm telling you to go out and buy Encana. Here's why. So their assets in the Eagle Ford Shale got better. They still have the awesome assets in the Permian. They have 2 assets in Canada, one that got better. And now they have an asset in the Bakken that they're going to sell for a lot of money to either Conoco or Continental. Somebody else that operates in the Bakken and wants a bolt-on piece is going to buy that hunk from Encana. They're already talking to people to sell it to. They just got to finalize details on the merger yet. So at some point, Encana is going to have this huge drop of cash to the balance sheet. And remember, they basically bought Newfield for some shares and some debt assumption. Encana's in really good space once they sell that asset. And here's something else to keep in mind. Royal Dutch Shell was recently talking about there's 3 or 4 places we really want to pick up assets in North America, and it happened to be the 4 assets. They named the 4 assets that Encana has.
There you go.
So Encana could do a number of things. They could transition out of oil by selling their Texas assets, maybe to 2 different companies, because their Permian assets are very, very valuable. And you have companies like Exxon, who just bought out another hunk of acreage after buying XTO a while back, and Chevron, which is going to spend more money domestically than they have in a decade. Chevron's, really, really winding down international operations because they know that oil in a decade is going to be much less valuable. So they're going to focus in the United States, the most efficient assets, and then on natural gas, and then whatever their transition plan is to a sustainable company in 20 years. But Encana, parts of the company are definitely a takeover target, even if the whole thing isn't. But I think they're going to have some very interesting strategic alternatives. Another company that I've been public about, because dividend growth investors want to have an oil company, is I've told folks, buy Occidental, replace Chevron and Exxon. Chevron and Exxon have such bloated balance sheets and so many assets that are going to die on the vine over time that ultimately they probably cannot produce enough oil and gas to ever pay off their debts. So when you think about an investment, you got to have investments that return cash to shareholders. And sure, Chevron and Exxon are paying a dividend, but at what cost? Are they going to hurt their balance sheet by doing that? And the answer is clearly yes. When you take a look at what's going on, their payout ratios are getting higher. Their cost of production is getting higher, so they have to go out and buy acreage at premium valuations. You don't really want the super diversified oil companies. You want the ones that are focused in places like the Permian and that already have good balance sheets. One of the nice things about Occidental is they got in front of a lot of this, and they built up their exporting facility in Texas. And then just when everybody wanted to have an export facility, they sold it for a lot of money. And now they have all this cash to distribute, to put into Permian operations. And they have two other things going for them. They have a carbon capture, a carbon mitigation business, and then a water business. And these are a big deal because in the fracking, water is becoming the wall that companies are running into, right? There's lots of sand out there. People ask me about the sand companies. You don't really want the sand companies. There's a lot of sand out there. But water is a lot more difficult to deal with because you got to get it and then you got to clean it. Occidental is ahead on that. And then I'll mention one other company, Pioneer.
That's what I was waiting for. I was going to say it, but I can't remember if you were public with that or not.
Yeah, the mother fracker, right? David Einhorn called them the mother fracker. And they have done something that I think is brilliant. They've basically sold all of their assets. They got a couple to go, but they sold most of their assets that are non-Permian. They are becoming a Permian-only company, and they are pouring money to their bottom line. And all these companies that I just mentioned are doing buybacks. They're starting to pay dividends. And frankly, all three of them are takeover targets because eventually the majors have got to transform themselves. Exxon and Chevron have already started, so the writing's on the wall that they're going to keep buying other companies, and we'll see how that goes. I also think there's going to be mergers. It would make sense to me that Occidental and Concho, or Occidental and Pioneer, or Pioneer and Concho. Oh yeah, I mentioned another company, didn't I?
No, there it is.
Yeah, Concho bought RSP Permian a year ago or two. Yeah, about a year ago, and they're a big. I think they're there's a couple companies that are right there that can claim they're the biggest in something in the Permian, but there's going to be mergers yet. Because it increases efficiencies, brings down their costs, their operating costs, and you can do really well. So one of the articles you can look for from me is an article on the Permian stocks that you can go out and buy. So my subscribers already know about this stuff. I'm going to put it out on the free side. I don't know if it's already up when you get to hear this interview after a few days. Or if it'll be a few days after. So, follow Kirk Spano on Seeking Alpha, and it'll be out there because the Permian plays are the best ones. And right now they're beaten to heck because of this correction in oil, because everybody knows about the WTI to Permian oil spread that's caused by the shortage of pipelines. Well, there's 3 or 4 new pipelines that are all going to come on from the Permian to the Gulf Coast between end of June-ish to the early 2020. There's going to be so much pipeline capacity coming on that Marathon is talking to Exxon about, hey, maybe we shouldn't build our pipeline. Maybe we should just work out a deal on capacity. And the reason they're talking about that is because they went from underbuilt to having commitments to being overbuilt. And that would really be bad for the gatekeepers, right? The toll keepers, the midstream companies, if there were too many pipelines. So they want to keep that in balance. Eventually more pipelines get built in the Permian because the US Geological Society just demonstrated that the reserves in the Permian are probably almost double what we thought they were. So the United States is never ever going to be short on oil ever again, so long as Mexico and Canada trade with us. We are going to be free of OPEC as a practical matter late next year. And, we'll still do some trade with OPEC. Venezuela is probably going to deal with South America and Central America and Europe. But, we still have Citgo here. And Saudi Arabia owns the biggest refinery in the United States down in Port Arthur. They need about 400,000 barrels a day for that refinery to supply the Shell stations that they have an interest in the southeast part of the country. So the Shell stations in the southeast part of the country are not all, but mostly owned by Saudi Aramco, and the Citgo stations are still Venezuela. So we'll still get foreign oil from OPEC because they've bought their way into our markets. But as a practical matter, by the end of next year, we don't need any OPEC imports. The only imports we'll need are heavy sour from Canada and Mexico. I will throw this out there in case there's an environmentalist listening, and I'm a tree hugger more than almost anybody else out there. I run a sustainable investing website too, because I think that transition is coming. But if we had one more pipeline from Canada,
right,
and maybe one or two more from Mexico, we wouldn't have to ever worry about what's going on in the Middle East again other than non-proliferation. So just keep that in the back of your heads, all you folks who, are opposed to the Keystone XL pipeline. That pipeline would be enough to support Canada's industry and economy and dramatically reduce how much we have to think about the Middle East. So, we spent $2 trillion in the last decade and, going on $2 trillion this decade on military excursions in the Middle East. Just saying, those are trillions of dollars that we keep at home. All we have to do is build a pipeline, which is way safer than trains.
Sure. Yeah. Kirk, so the basic theme I'm getting from this is...
there's a lot of things that are interconnected.
Sure.
Is I guess the bottom line.
Well, I mean, I think the big theme is obviously people are really worried about oil prices, and what you're saying is, hey, the Saudis and Canadians, they're pulling back exports to the U.S. That's going to drive up oil prices here in the U.S. to $70 a barrel, and oil will probably be range bound $70 to $80 for the most part, probably for the next at least 3 to 5 years, more or less.
For a long time.
Yeah,
for a long time.
You get later into the 20s.
I was just let me jump in here.
Yeah.
I was just talking to the COO of an oil company, and he said that shale is going to keep getting cheaper because the technology keeps getting better. It won't get cheaper at the same rate that it did when it fell off the cliff, right? Because shale oil went from break-evens in the 80s to break-evens in the 50s to around 50, and even in the 40s. We're not going to see break-evens in the 10s or 20s, but it's going to slowly drift down, and it's going to offset the cost of some of the inputs like water and labor. So we can make money. Our best companies can make money on oil that's around 50, even $45 a barrel. So we're going to hit this plateau in oil prices, 70-ish, 80-ish, I think. Because certain countries in the Middle East need it to be there, and Russia needs it to be there. And between Russia, Saudi Arabia, and the United States, that's a third of the oil produced in the world. You're going to see this peak oil plateau where there's a good balance. The best oil companies are going to make a ton of money.
Right, and that's the takeaway is that prices are going to rise for the reasons you mentioned, and probably be in that range for a while. And some, people can ride USO, maybe even using options like Leaps. And then there's also Encana, Occidental, Pioneer, Concho, either owning equities or maybe even owning 1 or 2 year Leaps if people want to be a little bit more aggressive.
Right. And there is an ETF out there that Jeffrey Gundlach has talked about and a few other big time investors have talked about. The Spider S&P oil and gas exploration and production ETF, XOP. So X-ray, Oscar, Paul, XOP. And that's pretty well diversified across the industry. There's one that's a little bit more expensive called FRAC, F-R-A-K. And I actually like the companies in there better, but it hasn't performed as well as XOP. And I think that has to do with the natural gas mix that you find in XOP. So if you're bullish on natural gas and on oil, XOP is probably the play. People like Jeff Gundlach are talking about it. It was his best idea last year at the Sohn Investment Conference. We'll see what he says about it in the next week or two. But, oil is going to rebound. And this time, it's not going to be the price of oil that is the star of the show. It's going to be all the profits that the companies, the good companies, the best companies can churn out. I would warn people, stay away from the super high debt companies because they'd never produce enough oil to pay off their bills. You need companies that are at 0.4, 0.3, 0.5 debt to equity ratios. You can't deal with these companies that are drowning in debt, and they have to worry about refinancing their debt in the light of a Federal Reserve that is not so nice anymore.
Kirk, as always, thank you. It's always great to talk to you about any topics investing-wise, especially when it comes to energy. You clearly, you've done your homework, and thanks for sharing with us today.
Yeah, well, hey, come on anytime. You know that you never have it hard with me because I just run my mouth.
It's perfect. I love it. It's interesting. I get a few comments in here and there. It's fun. So, awesome. Hey, thanks, Kirk.
All right, you take it easy.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.